Go ahead and dive in and talk about what's going on. Well, here's the agenda for the next hour. What I'd like to walk through first is what's happened so far in 2025. We'll walk through a few charts that I think summarize well the market activity of what has happened. Next, we're going to just walk through what's causing the recent market turmoil. And obviously, one of the key answers there is tariffs. And so we'll walk through tariffs work. And in particular, we'll dive into the China trade war. I'll have some thoughts on China and some of the actions that are currently being taken on both sides of that war. And then we'll just dive in to, will tariffs cause a recession? I think that's really the key question from an investor's perspective. And we'll discuss some conclusions and portfolio positioning. Well, with that, let's dive in. For compliance purposes, let me just give a quick important disclosure. Obviously, we're presenting our opinion on the market, that there's no guarantee that our views are accurate. We're going to be providing some forward-looking statements, and those should be taken as such. Those represent our opinions, and those opinions may change. So let's discuss what's happened so far in 2025. Well, this is a one-year chart. And I'm going to attempt to write on this. This is a one-year chart that I think shows the incredible run-up in the stock market over the last year. It was quite a ride, but mostly up, peaking in 2025. In February of 2025 was really the most recent peak in the S&P 500. We started the year basically with a 6% rise in stocks, followed by a decline of about 10%. So going into kind of the tariff turmoil, we were down about 4% in the market, followed by this activity here, a sharp, very sharp 10% decline in the market to be down a total of 19% off the high, and then a partial rally back to where we are today. Quite a bit of volatility here and quite a ride. So looking at the bond market, has been volatile throughout 2024, but really in the range of about 4% to 4.75 during 2025. The behavior in the bond market, I'm not going to get in too much, but I will say for the most part, the bond market is behaving the way that it should, in that in the face of stock market volatility, we have seen bonds hold up. That's some of the good news for 2025, and we're pleased with the behavior of bonds for the most part. There has been some discussion of this move here just in the last 2 weeks, there's been some concerning moves in the in the bond market. Um, that has since recovered. Um, and happy to discuss that if we have more detailed questions there. In the meantime, gold has been soaring. We've seen record highs in gold. This is the 1 year chart, and you can see this incredible rise as investors look to gold as a alternative to stocks and bonds. I've said to many of you, the a great equation for the price of gold is one divided by your trust in government. And so if there's policy uncertainty, if there's distrust in the direction of where government is going, often gold is seen as a safe haven, particularly in the face of geopolitical risk and conflict. So gold is reflecting that. On the economic front, one of the factors that we watched in 2024 and was really for the last 2, 3 years, I have been beating the drum that inflation is the factor to watch. And you can see um, uh, this is the 1 year chart. You can see that it has fallen throughout 2024, a concerning rise as we went into 2025, but the most recent at 2.4% for March is reflective of a general decline in inflation. That's a very good sign, and closer to the Federal Reserve's target of 2%. So good news on the inflation front. Also, oil has been falling. Um, Now, you can take a look at this and you can see this as a positive and a negative, in fact. Falling oil prices are good for the economy from the perspective that the consumer sees a lower price at the pump. Lower percentage of the consumer's monthly spending goes to fuel costs and gives them more free cash flow. So from that perspective, it's stimulative. Similarly, oil and energy is used in almost every product and production process, and so this becomes a way to lower cost in the supply chain. So from that perspective, lower price of oil is a positive and a stimulative for the economy. However, at these price points, this could also be seen as a indicator of looming recession, saying that the markets are expecting demand for oil to go down and could be a concerning signal as well. And so I would really just summarize what's happened so far in 2025 as this. The economy has been growing, and there's been several data points, several negative data points, but for the most part, we've seen positive economic data points, at least through the fourth quarter of 2024, and most of the data points that we have so far in 2025 have been largely positive. The job market remains strong, corporate profitability remains strong, inflation is falling. By most measures, we should be positive about the economy. However, the outlook is increasingly certain, and we see these fall off. So, what is causing the turmoil that we've seen over the last couple of weeks? Well, I think everyone already knows, the answer is tariffs. And really, I've been saying this for a while that see lots of positives in the economy. Tariffs are the biggest wild card. And frankly, those came in much higher, much more significant, and much more damaging than I think most market participants expected. And that's really what's causing the turmoil. So let's dive in a little bit deeper to the tariffs and what's been going on. So first of all, what is a tariff? Well, frankly, tariffs are just a tax, and I think that's important to remember. We can argue about who pays, but ultimately, it is a tax in its current form with the 90-day pause. Tax Foundation estimates that the Trump tariffs will increase the federal tax revenue by 171 billion, or about 0.56% of GDP, making these tariffs the largest tax hike since 1993. That's a big deal. And what that means is if the government is taking more of the pie, that just leaves less of the pie for consumers and corporate profits. And that's the bottom line. The rest of it is just math, and the market responds accordingly. That's not a value judgment on whether or not tariffs are a good idea or not. It's just increased taxation. It means less money in corporate profits, and profits drive profitability, and profitability drives stock prices. That's just how the math works. Now, tariffs are technically paid by the importer, but prices will likely be passed to the consumer, and I think that's important to remember. So the reality is there's been some discussion about who pays this tax. Yeah, I mean, the exporting country may reduce prices, devalue currency, or otherwise absorb some of the impact, but the most likely outcome is this is just an additional tax. It's additional cost that's going to be absorbed by a combination of the importer, the exporter, and the consumer. Okay, so the other element here has been the way that these tariffs have been rolled out. I would argue has been particularly chaotic for the market. So this is a detailed timeline of how these tariffs were rolled out. I don't feel the need to walk through every step here, but you all lived it and felt it. I certainly did. Where we have these announcements of tariffs, beginning in February, tariffs on Canada and Mexico, and then a pause on that, and then additional tariffs on China in March, and then kind of culminating with this April 2nd announcement. That was the big one, where there was this Liberation Day announcement with a baseline 10% tariff, and then these reciprocal tariffs that were much higher and much more burdensome than the market anticipated. Um, and therefore, the administration 2 days later, on April 4th, announced this 90-day pause, and that's really what caused the immediate drop down of 10%, and the partial recovery was this policy statement. Since that time, there's been this 90-day pause, and basically the 10% baseline tariff is in effect, with the exception of China, which President Trump and China have been basically in a trade war since that point. And tariffs on China are now, I believe, at about 145% on most goods in China. And so we have this ongoing trade war with China. That's where we are right now. And we'll talk a little bit more about that. Well, how much do tariffs cost the consumer? I think this is a great way to put this into perspective. So this is an analysis that was done by Tax Foundation. I think it's really helpful. So this goes back to 2023. And at that point in 2023, the tax revenue associated with tariffs equated to about $303 per household for U.S. consumers. And so, let's put that into perspective now. So this chart then shows you really the relative size of the tariffs before and after. Okay, so remember that $303 per household was the average effective tariff rate that was in place before Trump's announcements. Okay, so that's at 2.5% is what the average effective tariff rate was on all imports. Well, when after the the 90-day pause. So this is after the 90-day pause. The effective tariff rate on all imports with no behavioral adjustments ends up being 19%. That's with the burdensome tariffs on China. With some quote unquote behavioral adjustments. This is in essence the tax foundation's estimates of the burden of that tariff that will be spread out by the exporter and importer, not passed on to the consumer. That results in an average tariff rate of about 11.5%. So we're looking at about a almost 5x increase in the tax burden per household. If we use that $300 figure, we could look at $1,200 to $1,500 per household in additional tax. Okay, so that's just kind of, I think sometimes we throw around these numbers, 145% tariff rate, 10% tariff rate, and it's hard to put that into perspective. That's helpful for me, just to put this into a relative perspective on what's happening in terms of taxation to the consumer. So let's spend a little bit of time just doing some tariff basics. And so, how do tariffs work? Okay, you all may know this, but let's just kind of walk through how this works. The way that tariffs work is if you're in the United States and a pair of shoes sells for $60 and the domestic supplier manufactures that for $60, then the idea behind a tariff is that if a excuse me, Chinese supplier starts to supply the market with a cost of $50 per pair, what's going to happen is the Chinese supplier will simply sell a lot of shoes. They're cheaper. And so what the US can do is implement a protective tariff, in this example, a 20% tariff that would increase the cost of the Chinese shoes to the $60 so that it would be on parity with domestic supplier. That $10 does go to the US government as in the form of a tax. And as I said before, it's a decision point of whether or not that is borne by the Chinese supplier or the importer, or in this case, the consumer, in the form of higher shoe prices. So why would you even have a tariff? Well, there's several reasons, and all of these reasons have really been floated by President Trump. One reason is simply to raise revenue. This is a tax, and it's a way to raise revenue for the federal government. The second reason would be to protect the domestic industry. So, and this again has been floated by President Trump. Hey, we want to bring jobs back to the United States is the argument. And so, for example, the U.S. may decide that the car industry is a critical industry that we want to continue to manufacture cars in the United States, and therefore we're going to levy tariffs on imports of automobiles in order to protect that domestic industry. Now, obviously, that means that American consumers end up paying higher prices because they're not afforded the opportunity to buy lower cost imports. Or the other would be to achieve other policy objectives. So, for example, the administration has discussed the objective of having Mexico help with the southern border. And they've used the threat of tariffs to coerce compliance with that objective. Well, why not have a tariff? Well, one of the biggest reasons is economists generally agree, excuse me, that free trade increases the level of economic output and income, and it's a basic economic concept that we would want production to occur in the lowest cost by the lowest cost supplier. And that allows each country, each worker, each factory to use its highest and best use. So if a lower cost supplier can produce something cheaper, then that company, that country should be supplying that good or service. And that's just an economic, it's economic optimization, and it generally is accepted that that results in the highest output globally, which lifts all boats and everyone is better off. Okay. Um, so the idea, so conversely then, as we introduce those tariffs, then basically we're introducing a trade barrier that distorts the market and results in higher costs and reduced economic output and income. So because we're not using that highest and best use, because we don't have the optimal output per worker, now we end up increasing costs, which reduces the productivity of the whole system. And as a whole, we have lower in output and income for everyone. That's the idea. And then supply chains take time to adjust. So, many of these policy objectives, let's be realistic. Some of these products, um, they have moved over to China, and the production of these things have moved over to China, and it is a non-trivial event to bring some of that production back to the United States. And so sometimes these policy objectives are either unrealistic or they will simply take time to adjust, and there'll be a period of pain as we move production to in response to the tariffs. So, what is the administration trying to allegedly, what are they trying to overcome? Well, um, this is this is a summary. It's actually an output by the State Department that it's basically a 400-page document that usually nobody ever reads, that outlines basically the foreign trade barriers that U.S. company faces. And so here's just a few of the the points that were included in this document, and nobody probably would have ever paid any attention to it except for Trump referred to it. And so people kind of rush to read this thing and see, okay, what is the position of the State Department with regard to the foreign trade barriers that U.S. companies face. And so here are just a few. So the allegation is that for China, it's this China Inc. concept. um, and and the idea is that China strategically competes with straight state directed distortions. What we mean by that is that that it's that China Inc. When you compete with China, you're not competing with an individual company per se. You're competing against China as an entity, as a corporation in and of itself. And because of the size and ability and depth of the Chinese government, they can direct their companies to distort specific markets. For example, China as a country has specifically targeted the rare earth minerals as as a strategic market, and has sought to monopolize the rare earth minerals component of the global market. So that's one accusation. The other accusation on China is just forced technology transfer. So still to this day, and and I have in my career done a little bit of business in China, and and if this was the case 25 years ago, it's still the case that in order to do business in China, U.S. companies are forced by the Chinese government to localize the data and transfer technology to state-owned firms in order to get to access to the Chinese market. Basically, if you want to sell into China, you have to do so through a Chinese entity, Chinese subsidiary of which the Chinese government owns a significant percentage. And you're required to transfer any technology that you use to sell into into the Chinese market, into that subsidiary. And so that's a big deal. It results in a significant transfer of technology to Chinese companies. European Union, the European Union uses regulations for competitive advantage, basically adopting rules that implicitly favor domestic producers. So, for example, electrical standards that are only recognized by a European certification bodies, and that limits American firms' ability to compete or certify their products to be even sold in European markets. Canada is often referred to as the friendly fortress. So, for example, Canada has 245% tariff on some dairy products, and they prioritize, or they only buy from Canadian energy producers, which limits competition. So those are some of the things that if the administration is successful, if they are successful in eliminating some of these trade barriers, that could be a positive for global trade because it could allow U.S. corporations a more level playing field and ability to compete. So let's discuss for a moment the trade war with China. So who has the most leverage, China or the U.S.? You know, at this point, maybe it doesn't matter. Let me just start with we appear to be in a trade war with China, and I think it's important to just be realistic here. In that, regardless of whether you think the U.S. is going to win or not, whether or not you believe that China uses unfair trade practices, I happen to believe that they do, and I happen to believe that it's probably good to hold them to account to some extent. However, it's also important to realize whether or not you believe that's just or important or right. That doesn't necessarily mean that there won't be pain borne by U.S. companies as a result of a potential trade war with China, and so that's my I guess overarching thought on the Chinese market. And so, here's a graph that I think is helpful in order to put this into perspective. Okay, so this is a graph of U.S. imports from China. So the blue line represents imports from China in billions of dollars. So as of, I believe this goes through February of 2025, you can see that the U.S. is importing approximately 450 billion. That's as a 12-month sum. That's a rolling 12-month period. $450 billion over the last 12 months from China. On the other hand, the U.S. has exported to China approximately $167 million over the last 12 months to China. And so the difference here, this gap between imports and exports, represents our trade deficit with China, which is over the last 12 months was approximately $285 billion. And so, let's put that into perspective. So the U.S. economy is about $27 trillion over the last 12 months. And so if you look at it as of that $27 trillion, about $450 billion was imports from China. Is it overwhelmingly large? No, it's not. But it is large. It's a significant trading partner, and a trade war with China would hurt. Significantly, many of the imports from China are in electrical components, computer computer equipment, telecommunications equipment, for example, iPhones, um, also toys and sporting goods, furniture. So many manufactured goods. Conversely, the goods that we export to China are primarily agricultural goods, soybeans, rice, cattle, some planes, but mostly commodities that are being exported to China. So from that perspective, the goods that we import from China are much harder to replace. China is really the manufacturing center of the world, and again, you can argue whether or not that's the right thing or not, but from China's perspective, their trade balance with the rest of the world has topped now $1 trillion, meaning they export $1 trillion more than they import. They are a major exporter to the world. Again, putting that into perspective, of their exports, of their trade deficit, trade balance, excuse me, the United States represents 450 billion, or about half of that exporting balance. So we are a significant trading partner to China. And so if we end up decoupling with China, the bottom line is that's going to severely hurt China. It will severely hurt the United States. This is going to be painful on both sides of the Pacific. All right. So the real question is, will tariffs cause a recession? Well, here's one interesting way of looking at this. Nowadays, Polymarkets has a betting site for just about everything, and we talked about this during the presidential election, but they currently have a betting market on whether or not the United States will go into the recession. The current um, betting odds puts the chance of recession at 56% of a recession in 2025. Um, it almost sounds like a joke to quote betting markets, but frankly, the betting markets I find are incredibly accurate, um, and often reflect the combined intelligence of many economists. If you read the detailed economists, they are right about in the same place. And frankly, I think where we are is basically a place where it is almost virtually a coin toss. So 56%, we could argue, a little bit better chance of going into recession than not, but almost a coin toss on whether or not we're going into a recession in 2025. Our own economists, so I think I've shared in the past that we do use Ed Yardeni, and so you can look up yardeni.com. There are the economists that we follow most closely. Basically puts the odds of a recession at 45%, a little bit better than the Polymarket betting odds, but at the end of the day, not a helpful analysis, in that at a 50-50 chance, we're it's almost like saying we don't know. Okay, and that's the reality. I would argue that the current stock market pricing is reflective of these odds, meaning that the reason for the recent decline in stock prices is to price in the increased risk of slowing economic activity in the next 12 months. So why might, let's just kind of unpack this a little bit and kind of do our own analysis, okay? I mean, why might the tariffs cause a recession? Well, as we've discussed, the primary reason for the tariffs causing recession is simply that tariffs raise costs across industries, especially in manufacturing, technology, and retail, because um, the components often cross borders multiple times, and I think this is important to remember that, and I'll say in my understanding and experience that it particularly important in the auto industry. I think that's one of the reasons why we're seeing a carve out for the auto industry is because the auto industry in Detroit works very closely with Canadian factories just across the border. And many times these products are crossing the Canadian US border multiple times before the cars are ultimately finished. And so that can significantly increase the cost as we put in that trade barrier. So that increased cost ends up being a burden that has to be borne. It just slows the activity and raises the chance that we go into recession. The second is retaliation risks. And other countries could respond with their own tariffs. It appears so far that's primarily limited to China, but certainly there is a chance that we get into a tit for tat excuse me, tit for tat trade war where um, it almost becomes about winning rather than about the actual outcome. Sometimes politicians can get into it's about pride or um, their their respect, their global respect around the world, and I think that's on both sides of the argument. China has raised its tariffs, and they said that they are open to having conversations if Trump speaks respectfully. It's an interesting response. It's almost as if they are not respected, or respect is more important to them than the outcome, and and so there is a risk that in order to gain respect, they are, negotiate tough and simply retaliate. Um, Investor uncertainty. So one of the things that we have to be realistic about is the markets do not like uncertainty, unpredictability. So if if we remain for an extended period of time in this unknown, this period where we don't know what the tariffs will be, we're in this 90-day pause, that causes investors to delay making significant decisions. You can think of hey, right now, would you want to be buying a house, right? Well, okay, that's for us as consumers. Well, let's expand that to think about, okay, for those that want to invest $1 billion in a new factory, would you do that now, or would you pause until the policy becomes more clear, and and by delaying that expenditure, we we run the risk of dragging the economy into a recession because we're delaying making any big spending decisions. And so that's really across all markets. And then, the World Trade Organization has already forecasted a 0.2% drop in global trade in 2025, and they're citing the Trump tariffs. So they're already adjusting their forecast and saying that the tariffs are going to have an impact. Well, why might they not Um, well, as we think through what's going to happen, I mean, first, the the tariffs are still only on a fraction of global trade. Um, so if consumers and businesses adjust, for example, reshoring and shifting supply chains, well, then that the impact might be muted. It is possible that some products um, will get reshored. So, for example, Apple has made announcements to bring some production. I don't think final assembly will ever be in the United States, but some production on chips back to Texas. They've announced that they will move some production to India. Um, Other companies, for example, Eli Lilly has announced that they will move manufacturing back to the US for some pharmaceuticals. Um, and so, we can kind of go through these announcements. There is some ability to reshore some manufacturing that might mute the impact somewhat. Targeted exemption. So this is maybe one of the biggest unknowns. So already we see auto parts, steel and aluminum are excluded from some tariffs, right? This is just trying to protect the auto industry specifically. So these carve outs are targeted at preventing major shocks in key industries, and so that might mute the impact. Um, Strong domestic economies. So, for example, we did discuss how um, the the China imports represent 451 billion of 27 trillion dollar U.S. economy. It's important, but certainly the U.S. does have an important domestic manufacturing and consumer industry and economy, and therefore um, there is a chance that that absorbs the tariff fallout well. And then finally, and I think this may be, this is up to debate, but I think also maybe somewhat understated in this analysis is Trump wants a positive legacy, and so um, for better or worse, Trump does appear to be making these decisions um, centrally himself in large part. And so I think he believes that he can adjust the tariffs and the impact of the tariffs and course correct, as it were, if the damage becomes too severe. Again, we can argue whether or not um, that that is true, but there is, I think, as the April 4th 90-day pause reflected, um, there is this sense that of flexibility, and Trump has increasingly been discussing flexibility in these tariffs, and so there's still some chance that we see lower tariffs overall than was announced on April 2nd. So what's the bottom line? My perspective is this, that tariffs are like a headwind. So they slow things down. Whether or not they push the economy into recession will depend on how long they last, how other countries retaliate, whether or not we see panic in the financial markets, how the central banks and consumers respond, and I'll say, the impact of other stimulative actions, for example, lower taxes and regulation. So, if tariffs are a tax and we see action from Congress to lower income tax, that could at least partially offset the the um, the cost of the tariffs. Okay, so what are the implications for the portfolios? So I think one really important factor to consider is that volatility is back. The last decade has been a period of low volatility, but 2025 is likely to be volatile, has already been more volatile than much of, if we take out 2020 and the COVID crisis, we've seen some of the most volatile sessions in the stock market in more than a decade. And so it is time to revisit your risk level and make sure that you are appropriately defensive. And you all should know our philosophy on this. The time to prepare for volatility is before it happens. And so if you are um, and setting that strategy is is primarily dependent on what is happening with you in your life. And so um, being appropriately defensive to make sure that you can in your lifestyle and in your portfolio withstand market volatility, and that you're appropriately defensive starts with analysis and the plan that we pull together for our clients. And so let's just make sure that we're doing proper analysis and appropriately defensive as a starting point. Once we've done that, remember strategy is key. So if we've done that, if we've remained properly defensive, and in many ways, I'll say um, the bonds have really worked this year. So for those clients that maybe retirees and they are have a significant percentage of their portfolio in bonds, their volatility that they have seen has been much more muted than the 13% drop that we've seen in the S&P 500. And so that's a key example of how that strategy and that defensiveness can really help stabilize the portfolios and keep everyone on track. The next implication for the portfolio is diversification is important again. So in 2024, much of the rise was in the big tech companies. That hasn't been the case in 2025. As I mentioned, bonds are providing an important role in stabilizing portfolios. So bonds are a good place to be, have been a good place to be during this downturn that have provided some important stability. The other area that has been interesting is that international markets are outperforming the US for the first time in more than 10 years. And so international diversification has not been popular. Frankly, we still have a US overweight even today. But with international markets outperforming, it's worth a second look to look at international diversification in order to participate in those markets that are performing better. As I mentioned, some of the biggest declines in 2025 have actually been in the big tech names and biggest winners for 2024. And that's really just a reminder not to chase performance for me. There is a tendency to buy more of what is hot. And those that did that in 2024, where they piled into Meta or Google or Nvidia, they've been punished in 2025. It's those big tech names sold off and have been some of the worst performers so far in 2025. Which brings me to value is important again. So some areas of the stock market have already been priced in at recession levels. So, for example, small and mid-cap stocks, which have not been great performers in 2024, are actually at some of the cheapest levels in more than 10 years. And I say some of the cheapest levels in terms of their PE ratios as a measure of valuation, and also relative to large cap stocks, they appear to represent an incredible value at this point. And so I would argue that buying companies at good prices is always a good discipline in the amount of in the face of uncertainty. And so so buying those areas of the stock market where we see the best value. And then balance sheets are important as stocks face potential volatility and disruption. Um, so buying those companies that have strong balance sheets, and we do have mechanisms in the portfolio that do that, where we look at book value of the positions that are being purchased in order to overweight those positions with the strongest balance sheets. So those types of strategies have not been popular as the Nvidias and the Googles have taken off, but I would argue that those strategies are becoming more and more important as we face the potential of recession and face the potential for um, increased volatility, where the companies that we buy may be forced to weather some volatility here and potential disruptions in the economy. And so we do have significant investments in companies that in funds that are prioritizing those types of companies. So I hope that was helpful as we give our perspective on what's going on in the economy. And so let me then just ask for questions. I'm sure there are things that I haven't covered. Um, does anyone have any questions that you want answered at this point? Right. Well, I'm not seeing any questions come through. I mean, certainly, if anyone has a question they want to direct to me, free to reach out. Happy to have a conversation, or happy to email, answer any emails that you guys have. Hey, have a great night, and appreciate you guys taking some time this afternoon.